Hey. Hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst and writer at Cointelegraph. Today is Friday, March 17, and we will be discussing the impact of macroeconomic events on the crypto space. Don't worry, I'll explain everything without jargons, technical terms, and focus on the cause and effect on the day-to-day crypto trading activity. And what better way to start today's show showing you how to analyze a bank. After the Silicon Valley Bank collapse last Sunday, investors became more attentive to the imminent stock issues on the sector. This includes bailouts, crashes, and the subsequent wind down on the prices of the stock market, especially the regional banks. Well, the media insists on focusing on the stock price, but Silicon Valley Bank was trading at $267 a piece the day before the stock was halted. That's a whopping $15.8 billion market capitalization, not far from what the giant European Deutsche Bank is trading at $21 billion. So, if a stock price tells you little about the financial conditions of a bank, where should a trader focus? My answer: start by the enterprise value, or EV, which is calculated by subtracting the net debt out of the market capitalization. What good is having a street value if there's a huge pile of debt behind it? Many websites and services offer the enterprise value EV analysis for free. So, for example, let's start with Deutsche Bank. We can see that the shares listed even on the US stock markets holds a market capitalization of $20 billion. That's simply done by multiplying the last trade times the number of stocks outstanding. But the EV from the Deutsche Bank is negative at minus $31 billion. It means that the banks holds a lot of debt. Does it mean that Deutsche Bank is necessarily on the verge of a collapse? No, that's not true, because the debt could be either long-term or some previous government bailout ensures liquidity for the day-to-day operations. As a comparison, Banco Santander from Spain holds a $57 billion market capitalization. But this financial institution is cash positive, causing the enterprise value, or EV, to jump to $104 billion. That's, of course, what would one normally expect from a bank. Those are for-profit companies, so huge piles of toxic debt are not a good start. But what crypto has to do with banking valuation, one might ask? Well, the answer is everything. Bitcoin was created to allow anyone to be their own bank, and we're not exaggerating. Currently, for most of the normies, fund managers, treasury managers from companies, it would be hard to allocate a portion of the reserves in Bitcoin, but that can change over time. But right now, we seem a little bit distant from this, considering the meager adoption rate of Bitcoin as a store of value. Now, let's go back on how the banking cartel operates using the central banks. To illustrate the story, we need to go back to 2018, when the Federal Reserve denied an application for a banking license. Believe it or not, the founder and masterminder of the rejected application, called the Narrow Bank, TNB, was James McAndrews, a veteran of the Federal Reserve. So yes, a former director of research of the central bank, the Federal Reserve. What was so special about TNB that led to the denied application? Well, it would solely invest clients' money in US treasuries. No leverage, no loan originations, no credit, nothing. Just plain and simple pass-through of the interest rate paid from the government to clients using government instruments such as treasuries. Well, the Federal Reserve did not like that idea. It took them over 1 year just to justify the denial. Believe it or not, I'll quote, negative effect on the financial stability. If a bank is way more safer than others, it would disrupt the industry. What a joke. Sorry for the language. Okay, hold on a minute. Let's recap why we brought the banking sector to the table. Number one, the media focused too much on the bank stock prices. It would be very hard for a bank to collapse due to a 20 or 40% drop on weekly price crash. That's not how it works. The problem that causes, for example, SVB, the Silicon Valley Bank, is liquidity issues. They held long-term maturities, 5-year, 10-year notes, and the clients requested withdrawals in the tune of $42 billion in a couple of days. So they did not have that position in cash. That's not something specific from SVB. The banks are required to maintain some 14-15% of the money in the base. So basically any bank, if there's a 20% withdrawal request in a couple of days, the bank necessarily is going to fail and need external funding. So that's what causes those liquidity issues and consequently interventions. What about Credit Suisse, which seems to be the bank most talked currently because it just got a support funding of $50 billion from the Swiss Bank Authority? Well, Credit Suisse is big. It holds total assets of $556 billion. Yes, that's large, that's relevant. Probably they have a larger derivatives exposure, or some companies in Europe are really dependent on Credit Suisse. But looking at the broader picture, $550 billion is not much for a bank. For instance, the Bank of China holds 3.7 trillion worth of assets. JP Morgan Chase, another $3.3 trillion. BNP Europe as well, $3 trillion. That's 6 times larger than the Credit Suisse. Even mid-banks like Banco Santander, which you mentioned earlier from Spain, holds $1.8 trillion in assets. That's over 3 times more than Credit Suisse. So yes, there's a risk that the issue of liquidity starts by regional banks, then scale up to medium banks, and eventually would be impacting the larger banks. But right now, there's no such risk. The media wants to FUD, the fear, uncertainty, and doubt, but that's not how the financial system works. And as explained earlier, even if the Bank of America or JP Morgan stocks crashes 20% in a week, it doesn't mean that the bank is in the imminence of failure. Number 2, an eventual failure of banks, which should bring a positive spin to crypto, is unlikely sustainable for the price. I'll explain why. The correlation between stocks and cryptocurrency remains very high. So when one market moves up, the other tends to follow. So if investors price a higher risk of recession, stocks tend to go down, and Bitcoin is also negatively impacted. On to the next topic. This time, we'll discuss the bond debt market. If you think gold is a huge market at 11 trillion, or the global stock market at $85 trillion, you're in for a surprise. The debt markets stands at a whopping $300 trillion when adding companies, governments, banks, and families. Okay, so the debt market is 3 times larger than the gold and stock markets combined. So what? Now comes the fun part. When you loan your money, let's say to the US government, by purchasing treasury bills, you know in advance the exact annual gain, whether it's expressed in US dollar terms or based on inflation data. The problem is, if the governments inject more money into the system or drastically increase interest rates, your theoretical gains in the fixed income become an adjusted loss. Now, new debt is being issued at a much higher premium, so paying much more compared to similar bonds from the previous years. So let's say the treasury bond was paying inflation plus 2% for the period of 4 years. Now, the same treasury is paying inflation plus 4% for a period of 5 years. In short, investors that decide to sell the bond holdings right now are going to take a loss, considering the new issues are paying higher returns. That's exactly what most banks, mutual funds, and even companies are bag holding right now. It's called unrealized loss because you can hold until the maturity and get paid the CPI plus 2% agreed 2 years ago. But the new bonds are paying CPI plus 4%, for example. So if you compare his returns to the current inflation, he's not gaining much or even losing money. But even if they take that loss, even if they sell that bond that they purchased 2 or 4 years ago, what are they going to buy next? Gold? Stocks? Real estate? Bonds again? It is premature to foresee, but I highly doubt anyone is going to do the same mistake again. As for the stock market, declining earnings in a recession environment is not exactly welcoming. Okay, ready for our final recap? Number 1, bond markets are huge. Banks, companies, and individuals are bag holding debt instruments paying much less than the current ones. They can either lose to inflation year by year or sell it right now and take the loss. Number 2, there ain't so many liquid assets, instruments available to capture a $30 trillion inflow in a couple of years. And even if 1% of that's $300 billion, flow into Bitcoin, that accounts for over 60% of the current market capitalization. In short, fixed income investors of a $300 trillion market are losing money. They are sitting on unrealized losses. It's not that the nominal value of their holdings will decline, it's just that the earnings does not compensate inflation because of additional money injected in the system and raising interest rates. So it's called unrealized losses because if this investor, bank or a company or mutual fund or retail investors sells that bond right now, he's gonna take a loss. Of course, he's only forced to sell if there's liquidity issues. And a recession environment is the worst moment for that because there's fear and there's cash liquidity, both for companies and retail investors. Well, that's it for today. Remember to like and subscribe the new Cointelegraph Markets YouTube channel. We'll be airing every Friday, 12 o'clock p.m. noon Eastern Time. Make sure to like and subscribe. Thank you.